Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Through the Noise. Now, the rise in US bond yields in recent weeks has been an illustration of some of the jitters in markets about what exactly the Trump administration's policies are likely to look like and how they balance with what we've seen in recent data releases in the labor market and on inflation. Now, of course, after the move we've seen on yields and indeed on the US dollar and equity markets, the question in front of us is whether markets are presenting us with an opportunity or whether we should be cautious about more volatility ahead. So, which way should we be looking? To discuss that and more, I'm happy to be joined today by Audrey, who's head of asset allocation at the CIO office. So, welcome, Audrey. Thanks very much for joining us today. So, Trump returns to the White House on the 20th of January. In your view, what do you see as his policy priorities against the backdrop we just discussed at the opening?
Well, thanks, Manpreet. I think one of his first tasks, in the office is likely to assuage the bond markets because we've seen a sharp rise in U.S. bond yields over the past couple of weeks, which basically reflect still pretty resilient U.S. growth, but also rising concerns about the impact of Trump's policies. So investors will likely look for reassurance that he is responsive to markets, and we believe he will. In fact, when we look at some of his closest advisors, including Treasury Secretary nominee Scott Benson, he's a market veteran. Hence, although Trump is likely to start delivering on his election promise, including imposing tariffs on trade partners, we do expect him and his team to likely craft policies with a sharp ear for feedback from the markets. And some of the reports we have seen suggest that some of Trump's advisors are studying gradual tariffs hike of, say, between 2 to 5% per month, primarily as negotiating tools to achieve the objectives of boosting US exports, curbing imports, and bringing back manufacturing investments and jobs to the US. So, against this backdrop, we remain largely pro risk in our asset allocation, and we expect his pro growth tax cuts, deregulation plans, to outweigh concerns over his trade and immigration policies.
Okay, so maybe just building right off that, given what you just described, what's your view on equity markets? I mean, we had the rise in bond yields, but we also have a pretty optimistic earnings season. Is this an opportunity?
Well, over the past couple of weeks, we have seen a pullback in risky assets on the back of what you rightly mentioned, higher bond yields, and of course, higher dollar as well. That being said, we do see the recent consolidation in the US equity market as an attractive opportunity for investors to add exposure. First of all, a moderation that we have seen over the last couple of days in US inflation in December basically calm worries about an inflation rebound, which could have otherwise caused a further rise in the US 10-year government bond yield. And second of all, if you look at the US Q4 earnings season, the early signs are pointing towards still healthy, robust earnings growth. And according to iBest, the S&P 500 earnings are expected to rise by about 10%, 10.4% in Q4, which is an upward revision from just below 10% at the start of the year. And specifically, if you look at the financial sector's earnings, they are expected to grow at about 25% in Q4. And as of 15th of January, the sector has also delivered an earnings surprise of about 18%. As a result, we do expect US banks to continue to do well, driven by a recovery in investment banking revenue, as well as sustained net interest margins. Obviously, a less dovish Fed remain a risk for the sector as well as for the markets. We still remain overweight on US financials and expect them to be largely fueled by strong growth that I mentioned earlier in terms of investment banking revenue, as well as benefiting from potential deregulation, as well as a steeper yield curve.
Okay, so let's maybe shift focus to the bond market. I mean, the last data point was inflation, which came in a little bit softer than expected. In your view, what's the likely impact to be on bond yields and indeed on Trump's policies in his first few weeks?
So the rise in US 10-year bond yield was tempered most recently in recent days, specifically after the release of a softer than expected producer as well as consumer prices this week. Despite the inflation worries, we continue to expect that the Fed will likely cut rates by 3 times this year. which is more than the 1 to 2 expected by markets. So while long maturity yields can remain elevated, we see limited potential for significant spikes from here, particularly in a scenario where Trump is likely or potentially thinking about pacing out tariff hike, indicating an awareness of the impact that these tariffs can have on inflation. So in theory, a more gradual increase in tariffs will lower immediate inflation impact. However, it could also lead to a buildup of long-term inflation expectation, and it is still unclear if such an impact will be long-lasting. So against this context, we do see opportunities for investors to lock in today's attractive yield for income. And within the bonds space, we have a preference for developed market high yield bonds as default rates remain still quite low in a resilient US economy as well as earnings. And from a duration perspective, from a maturity perspective, we do believe that a 5 to 7 year maturity bucket will likely offer a more attractive trade-off between exposure to potential repricing or more Fed rate cuts and the yield pickup from longer maturities.
Okay, so we can't talk about yields without talking about the US dollar. I mean, what's your latest view on the dollar, indeed on FX markets more broadly?
So we've just updated our 3 month view on major currency pairs, and the changes are largely driven by an upward revision in our US dollar forecast to 107 from 106 previously. We've seen in recent weeks the greenback having risen to test 110 on the back of stronger US labor market data, as well as the resulting rise in the US bond yields as well. However, a repricing or a potential repricing in Trump's policy concern, a softer US core inflation reading, and reports that tariffs hike may well be introduced in a more gradual fashion could also help the US dollar to partially reverse its rise, especially in the event when we also see US bond yields also softening at the same time. So against the backdrop, our forecast for pound over the next 3 months has also been revised lower uh, to 1.24 from 1.28 previously. So if you look at the UK inflation, it has unexpectedly cooled for the first time in 3 months in December. And that basically is fueling expectations that the BOE will cut rates by more this year. And this has also helped calm the pound bond market, the GBP bond market, after a week of turmoil, which pushed yields to a 17-year high. So lower yield should also help to should help to cap gains in the pound, even if the US dollar turn lower. So from a pound perspective, we see 1.2 as a key near-term support, where a short-term rebound from oversold territory is quite likely from here.
Thanks, Audrey. And finally, maybe just wanted a quick chat about oil prices. We've seen them rebound again because geopolitics never seems to be far away from the conversation. What's your latest view there, and arguably on some of the commodity currencies that might be impacted by it?
So oil prices have been quite well supported in recent weeks due to expectations of potentially renewed US sanctions on Russia's energy industry and Iran and the impact it could have on supply. Recent US data have also shown a drawdown in oil inventories, which basically added to near-term supply concerns. However, on a full year basis, we continue to believe that oil market to be oversupplied with relatively weak demand growth balanced by what is likely to be a significant supply and spare capacity from both within as well as outside of OPEC plus. So what this means is that oil prices are likely to be capped unless the demand outlook improves significantly, for example, via a very strong, say, China growth stimulus. So from a domestic fundamentals point of view, we see Canada's term of trade having risen significantly since mid-December. And this is while at the same time, when we look at the labor market, it has surprisingly improved as well. So what this means is this is likely to act as a tailwind for the Canadian dollar. And we see US dollar CAC edging lower in the near term and potentially testing its support at the 50-day moving average at around 1.42.
Okay, well, thanks very much, Audrey. I think we're about out of time, so we'll bring the conversation to an end there. Thanks so much for taking the time to speak with us on today's podcast. If I can sort of just summarize what my top three takeaways were from our conversation today. Number one, US equities potentially an opportunity amid what is a strong earnings season. Second, just looking at bond yields, we may be faced with an opportunity to lock in income. And finally, take a closer look at our revised 3-month FX forecasts in our latest publications and potentially keep a watch out for an opportunity to sell the US dollar. So with that, we'll bring today's podcast to an end. Thank you, listeners, for tuning in, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.